How's it going, everyone? Welcome to the Proving Ground Mastermind. We're going to get started here in just a few minutes. As you guys get logged in, let me know if you can see my screen, if you can hear me talking. And, of course, if you have any questions, feel free to ask, and we'll get to them at some point within the session. All right, let me know if you guys can see my screen and hear me talking. We're going to get started here in just a second. Okay. All right, welcome to the Proving Ground Mastermind. So last time we talked, we discussed the seven-figure day trading and how we'd go through each of these steps to get to a point where we've got a solid trade plan that we're executing on. And there were some holes that I wanted to fill for that particular session. One being establishing what your setup is, and the second is analyzing the data after you've backtested it. And I know we've talked about analyzing the data in the past, but I wanted to include that in this series. So we're going to talk about that next week, but this week we want to figure out establishing a trade setup. And we kind of touched on that, or rather we kind of just made up a setup, and we're going to go back and backtest that. Now, I did actually backtest a different setup, and I'm going to show you guys that setup today, but I want to kind of go back to what we were talking about just briefly on how we would establish what it is that we're going to use for a particular setup or something that we've noticed, right? And so basically what we're looking for with the made-up setup that we were looking at was a couple things. One was when the major and minor have pivoted in the channel and are just getting, and I don't think they're even oversold or overbought. Hey, Paul, welcome. So, you know, not necessarily being oversold or overbought, but just kind of getting to the threshold of the oversold, overbought after pivoting in the channel. And then we wanted to have, I want to say those are the only parameters we were looking at the time. So if we go back and we start looking at that and we start to realize that we could very well get, so let's look for an example. We could very well get a better outcome if we're not limiting them to just pivoting in the channel, or not limiting them to just getting onto the threshold, but maybe partially overbought or partially oversold, or pressure in our favor, or TNTs in our favor, one of the lines of TNTs or multiple lines, whatever it might be. Then we want to add those. So the way we do that is we want to just consider them for a moment and put them in the notes, right? Well, major minor didn't pivot in the channel, or majors, green major was partially overbought, everything else was oversold, or whatever it might be. And as you go through and start collecting some of this data, and you could just kind of do a 3-month test, right? You can go back 3 months and check the viability of it before you do a full audit, before you do a full back test. You can just go back and look to see how these are going to play out, and if they're going to play out the way you expected them to. Now, what we were expecting was reversal. So let's find an example so I can kind of show you what we were working with. So hypothetically, if this pivoted and pointed up and was just on the threshold, then we would consider that one, right? So it has to like pivot in the channel. Hold on. That's the other thing. If you're not getting a lot of frequency, it's not happening very often, you know, it may not be one that you want to spend a lot of time on. Here's one. So it kind of pivoted, so it's in the channel, and then it kind of changed directions. Now, they're not touching the threshold yet, so again, you might want to be a little more lenient with some of those parameters, right? And then we want to say, okay, you know, are we going to get reversal? And if we do, how much are we going to get? So in other words, it's green, so we'd potentially be looking for a short movement right here, and then determining by making notes if it's going to be viable in one direction or the other. And so, like in this particular case, we went up 11, and then by the third hour went down 17.5. So that could very well, for the time you trade, be, you know, kind of run of the mill. So as you go through and you start to notice things, okay, this is going to give my trade more viability, or that might give my trade more viability, you're not adding those parameters to your setup, you're just taking note of them. You're just taking note of what happened, and then after about a 3-month audit, you can go through and kind of look at it and say, okay, did that do what I anticipated, right? And if not, or if so, were there any other parameters that we could potentially add that are recurring that could help us be more successful at that particular trade? And you want to stay within those parameters that we talked about before, right, when we're first establishing a setup. No less than 2 parameters, but no more than 6 parameters, so 2 to 6 parameters. Because if we start adding too much, then it just becomes too complicated, it becomes very difficult to backtest. But more than anything, when you become emotional about your trading, you start to just drop rules or parameters and not look so stringently. The other thing is if you have too many parameters, it does tend to decrease the frequency or the amount of time that it happens. So I did want to address that really quickly because I did have some questions about that, so I wanted to take a moment to talk about that. But yeah, just do a 3-month audit. Now that 3-month audit is not for the purpose of trading and using that information for your trade plan, but just to test the viability of that trade setup for the times that you trade. Is it going to go the direction we think it's going to go, or should we start looking at it differently? Should we start looking at it like it's going to go the opposite direction than we initially thought, right? And then as you go through, of course, take note of any of the other parameters that you might see that could potentially benefit you taking that trade more profitably. And then when you're done with that audit, then you look at the information and determine at that point if some of those parameters or none of those parameters are viable, and the way you're looking at it is viable. Is it a buy indication? Is it a sell indication for you specifically for the specific times you trade? So you're still going to use the same model when you're testing viability. You're still going to go back to the specific times that you trade on one currency pair, and then the parameters that you have that are theoretical at that point. And then you're going to add from there or subtract or whatever it might be, so that at the end of that audit, you can determine what it is that you're going to do a full back test, a full audit on, and what parameters are going to be valid for that audit. And whatever they are, you're very intentional about, and you have your yes, no, maybe, right? Yes, it's a setup. No, it's not. Maybe it's a setup, which is also a no. Now, keep in mind that even though you've done that audit and you're settled on your parameters, you may still very well start to notice things as you're doing your full audit, your back testing. And I would encourage you to take note of those things. And that way, when you get to the end of your back testing, you could go back and look at that and see what it is that you noticed. Because worst case scenario, you can't use it, but you've learned something, right? You've learned how to look at the indicators in a different way just by kind of paying attention to some of those subtle nuances that occur when your setup occurs. So there's a lot of value in back testing. And I can tell you right now, the way things are going, eventually we're just going to have auto back testing. And we've talked about this in the past, where doing it this way, manually back testing, is going to be archaic. It's going to be something that you guys aren't required to do or don't do anymore. And in that way, you'll find that some of that learning that you acquire by backtesting will be lost. And then reading the indicators fluidly will just be a lost art. Some people do it, others won't. But give it 10 years, and I bet nobody's trying to learn how to read the indicators more fluidly. They're just taking the backtest information, using it, and becoming successful with it. And that's fine. That's okay, right? That's the idea. But some of us want to dig a little deeper. And so just remember that you'll always have that information in the mastermind that you can access, so that when you want to dig deeper, you want to learn how the indicators work more fluidly and have a more advanced understanding of them, you still have that information. But I can assure you that at some point, the information is going to be watered down. The process is going to be watered down. And it's not that it's not going to be effective. It's still going to be effective. You're still going to be profitable. You're still going to be able to win. But that byproduct education that you get by just going back and looking at how the indicators ebb and flow while you're waiting for your setup to occur is invaluable. It teaches you this. It opens up this whole new realm of understanding for the indicators. Okay, so I want to show you this new trade setup that it's a user submission. So one of our members submitted this setup, and it's really interesting because I had my doubts initially. And so let's see, what's the date today? Let's just go to last week. Okay. And then let's throw on. And if you guys joined us on Friday for the sweep, you saw this, and you actually saw the data. But we're going to go over it in a little more detail. So again, ask questions as they arise in your mind, even if it's not relevant to the lesson, and we'll get to them, okay? All right. So what we're looking for is in the thick orange. And what we want to see in the thick orange, so that's not one. Let me find one before I confuse you guys. That's not one. Okay. So in the thick orange, like the half top, we want to see the value at 50 or 5. If you're using the green chart 2, then this will just be 5.0, right? And if the thick orange is up, then the indication is going to be up. Now we also want the thin orange pointed up, but we want it to be higher than the thick orange, okay? Not its value. I tried that, and this is where I was like, it doesn't matter, because the value could be, 55, and it'd still be visually above the thick orange. So see right here, it's higher than, just the line is higher than the thick orange. It's just higher than it, right? Or if they're down, then the thin orange is going to be lower than the thick orange. But its value will sometimes be, let's say, negative 55, right? Which would mean that it is lower than the thick orange. But we're not, and it's still represented as being higher on the chart. So we're not looking at the value of the thin orange. We're just looking at, when you look at it with your eyes, that the thin orange is visibly higher than the thick orange when we're taking a buy, or visibly lower than the thick orange when we're taking a sell. So they both have to be pointed up. The value on the thick orange has to be 50, and the thin orange has to be visibly higher, pointed up, than the thick orange. So those are the two parameters. And the third is just the majors are also pointed up. Okay? So right here, and what we're expecting to happen is a long movement. And let's just, the same parameters we used as an example on Friday, I think, were just like a 10 pip stop loss and a 10 pip take profit. So let's just play around with that. And again, these are not the parameters that you would trade this at, right? And if you want to be lazy and use them, fine, but your laziness is going to get you failure, and you're going to be sad about it, and that's going to be your fault. But we're just using this just so we have kind of a goal to look at, right? It's not because we're actually going to trade it at those parameters, okay? So we would be expecting a long trade here, thick orange pointed up, thin orange pointed up, thick orange at negative 50 or 5, majors also pointed up, and then the thin orange obviously visibly higher than the thick orange. And first candle, 11 pips, so that's fine. It did draw down about 4.7, but it went up 11, so good. Okay, and then, so let's go to the next example. Let's just find it here. Okay, so right here you can see that the value, whoops, not there. Right here you can see that the value of the thick orange is 50, but the thin orange is below, not its value, but visually it's below the thick orange, so that wouldn't count. Majors are pointed up, but that would not count. So you can see the green pylon because I programmed it to give me the green pylon when those parameters are visible, when thin and thick orange are pointed up, but there's no way for me to say when the thin orange is above the thick orange because you can't compare, as far as I know, the two of these except for by their value, but their value is not going to accurately represent where visibly that thin orange is higher or lower. So, and maybe there is a way, but I haven't figured it out, so I didn't use it for this pylon. So if you're getting confused as to why it's a green pylon, but it's not the setup, it's because it's only partially programmed in there. So that's kind of what gave me some pause, was that the thin orange can be at a different value or a lower value or a higher value and still be above or below the thick orange. So that's kind of what led me to be skeptical as to whether or not there was any validity on that thin orange. But after backtesting it, I found that yes, in fact, there is a lot of validity in whether or not the thin orange is higher when it's buying or lower when it's selling. It's more accurate. It doesn't mean that it always loses when the thin orange is not in that particular place, but that it doesn't consistently win. And we're looking for consistency more than anything. And I'll show you guys what that looks like in the backtest data. Okay, so that's not one. Let's go back. This is one, right? Thick orange is at 50, pointed up. Thin orange is also up, and it's higher visibly than the thick orange. Majors are pointed up, so this would be a long trade. And this one went up 4.7, down 3.9, so nothing yet. Right there. Yeah, 18. Yeah, 18 pips. So on that candle, it would have been just fine. See if we can get a sell in here. Okay, here's one. So this is a sell, right? The thick orange is down at value of 50 or 5. Mine, thin orange is down, and it's lower, visibly lower than thick orange, and majors are pointed down. So right there, we got all the three parameters we're looking at, and we'd look for a short trade. And initially, it went up about 6 pips, and then down 12.3. So that would have been just fine as well for what we're looking at. Obviously, we're looking at 6 candles, but we want to just see in our, if we're going for 10, then we would have just stopped counting right there. In 6 candles, it still actually would have been about 16.4 with about 3 pips of drawdown, right? Because that's the most it went in our favor. And then if this is the most it went in our favor, then everything that happened before that, or the furthest it went against us before that point, is the drawdown. So that's the drawdown, that's the peak profit. Okay. All right, so that's the setup. So play around with that, backtest that one. That could be another good one. Let's just see if we have another one here, because I think we had a couple in here. Okay, so this one's kind of tough, right? We can barely see that the thin orange is above the thick orange visibly, right? We see it right there if I stretch it out. Thin orange, thick orange. Thick orange is at a value of 50, and majors are pointed up. So again, that would be a long trade. And let's go forward. That one moved initially 11.3. It drew down about 5.5 and then went 11.3. So right there on that second candle. Let's see. Yeah, 8.3. Sorry, 12.7 is what it went. And that would have made us profit right there if we were using the 10 and 10. Okay, so what I did is I went back and I tested 100% of it. One, because I want to show you guys that if I'm asking you to do it, I'm not going to exclude myself from that. I'm going to do whatever I expect you to do. Now, when you guys backtest, you're only going to backtest a certain couple hours, right? Maybe 4 or 5 hours at most. Okay? I went and backtested 100% of them. Every time they happened within a 24-hour period from January 2016 all the way to December 2020. By hand, I didn't use any program or anything to do it. I just did it all by hand, collected all the information, and then made some notes that I felt were significant. So because this is not a setup that I created, I wasn't looking for any additional parameters. I was just looking to validate or invalidate whether or not this would be a good setup. And of course the validity of that thin orange line being above or below the thick orange when the parameters set up. So you can see that altogether I end up with about 636 examples. Okay, so quite a few, but if you consider that I did all of them every single hour, then it's actually not that much, right? It doesn't work out to be that much, primarily because 600 and some odd over the course of 5 years is, let's just say 100, let's see, let's just say 637 over 1,000, so 1,000 divided by 637, and I use 1,000 because about 200 trade days in a year times 5 is 1,000, right? 2, 4, 6, 8, 10. So 1,000 trade days in a year divided by 636, right? 636. So it's about 1.5 trades a day. If you took them 24/7, right? 24/5, 24 hours a day, 5 days a week. So that means that no matter when it happened, you would take it. So 1.5, that sounds like a lot, right? But when you break it down, you may only be taking them between the hours of, say, 0 to 5, right? This is UTC time. So this is going to be like 6 to midnight or whatever, right? 6 p.m. UTC, Mountain Standard Time to like midnight. So we can see that if we took them just in that time frame, right, that's like the evening session just before the red eye. So if we took just that, then we have about, actually I should have it listed down here, 164 examples. So 164 times that it occurred between the hours of 0 and 5 UTC, right? So 1,000 divided by 164 is about, what did I do wrong? 164. So that's like 1 every 6 days, right? 1 every 6 days. So that's not a lot. But so you know, it may be something that, or perhaps you're only trading 2 of those hours, you're trading 2 of, you know, another hour or whatever. But if we look at just that, so what I did is I broke it up between trade sessions. Okay, so if we're looking at, and this is just my opinion, if we're looking at trade sessions, then I would say let's start at midnight Mountain Time, so 2 a.m. Eastern, midnight to about 5:59, right, just before 6 o'clock, would be like the red eye session, right? The morning red eye session. So if you're in service industry or you work swing shifts or you work nights for whatever reason, you know, you are at work during the times that most of us are sleeping, and then maybe you're getting out of work at 2 or 3, 4 a.m. and then you're trading, right? So that's that red eye. And then from 6 to 11:59, that would be the morning session, and these are Mountain Standard Times. And then from 12, right, to 5:59, that would be the afternoon session, and then 6 to midnight, 11:59, that would be the evening session. Okay, so that's the 4 sessions that that's how I look at the day in those 4 sessions. Why that's important, especially for those of you guys that are using stuff like the what is it called? Oh man, the EMA, like the exponential moving average, right? So I've seen this pretty often on our green chart too. Actually, it's there all the time. So the ATR, average true range, right, which is kind of giving you an average of the last 5 candles because it's set to 5. So if we're using a 60-minute, by the way, we're taking the average of 5 hours, okay? Now, we know that right now the market tends to settle, right about here, okay? Right about there, the market tends to settle. It starts, moving slower most of the time, right? So after the last hour. So if we're looking at the average true range of the last 5 candles from this point, right, then we're looking at that candle being 19.8, 19, somewhere around there. This one being 16.4. This one being, come on. Oh, lock, that's what I meant to do. This about the same. So about 15.7. So that's 3. This is 4. 18.6. 5. 13. 13.5. So you're still looking at, if we did this, this would be, because I want to show you guys why you want to be cautious with this stuff. I don't use ATR. I don't use any of that stuff. I just use backtesting. So let's take this one, 19.6. 19.6 plus 16.4, 16.4 plus 15.7, 0.7 plus, yeah, those are the same, okay, 15.7 plus 13.5 divided by 5. What did I do wrong? Oh, I should have equaled, and then somebody should tell me how to use a calculator. Okay, I'm just going to wing it. So let's just say it's like 15 pips, okay, because we've got like 16s in there, we got 13s in there, we got 18 and 19. So it's like, let's just say 15 pips, right? So now we're going on the basis that the last, and this one might even be that as well, right? So this one might be like, yeah, 12.6. This one that we're currently on will start to become smaller and smaller, right? So right here, this one's about 7.3, right? So we can see there's already starting to become smaller. So if we're going on the preface that the market's been moving in about 15 pips, that was correct, but now we're in a different market condition, right? We're in a different trade time or trade window, right? So that's not going to be useful to us. And before it is useful, we'll be outside of that trade window, right? Because we're using these smaller candles, and we have, after this hour, we'll have 2 of them, and then 3 of these bigger ones. So that's going to throw off the average, because it's just an average, right? And then another one comes out, we're still using 2 of these bigger ones, and by the time the 4th one comes out, then it's going to look a little more accurate, because the 3 smaller ones are going to supersede the bigger one, right? And the only other way to do it is to not use an ATR, but use a weighted average, which you can't use a weighted average because unless you do the math by yourself and know how to weight the data, so that for example, if we had one candle that went 100 pips and then 4 candles that went 10 each, right? If we looked at the average, just the straight average of that, then that 100 is going to throw off the fact that we're moving at about 10 pips. Okay? So if you weight that, then it falls more into line with what we're seeing here. right? But the ATR, by the way, doesn't do that. It doesn't weight the information. It just gives you the average true range, just how it sounds, right? It's not something magical, right? And that's why we don't really trade on the average true range. We don't use it as our trade entry. We just use it to see what we could potentially get out of the market, or if you guys use it. I don't. But and honestly, I don't recommend using it, but that's up to you guys, right? So if you're moving between trade sessions, then you're going to have, that's going to be skewed. Now, if you're using a 5-minute, then obviously, you know, I would say, you know, 20, 30 minutes into this first candle right here, you're okay, right? Because you're getting those smaller movements even on the 5-minute, right? So, you know, 20, 25 minutes into this candle, then you're going to have five-minute candles that are representing the new market condition. Okay, so your ATR is going to take the average of those 5 candles within that 25 minutes. So just a heads up there. If you guys are finding that you're not finding consistency with your stop loss and take profit using the ATR, that could be because you're jumping between 2 different trade sessions, right? Maybe you're catching the tail end of one trade session and then moving into the next trade session. So just be aware of that. Okay, so let's look at this data. And so what I did is I broke it up a couple of ways, just playing around with it. And I've actually gone further than that, but I want to show you just these few examples for now. So first thing I did is I sorted by drawdown. That's the first thing I did. I sorted by drawdown. And the reason why I do this is because I want to see if there's any kind of drop off. So we can see here, I'm not worried about those zeros, right? Because that's zero drawdown. But if we go lower, we can see, okay, 3, 4, 5, 6. Okay, and it starts to get really big. Right here at 12, we can see from 11, it goes to 12. And there's only one 12 right there. And then it goes 13, and then a few 13s, then 14, just a few 14s, then to 15, then all the way to 17. So there is a drop off right there, right? From 15 to 17. Where kind of, you know, if you had anything above a 17 stop loss, then you know, you're in pretty good shape, because here we only have about 18 losers. So if we didn't have if we had a stop loss that was not that was above 17, then in terms of the market moving 17 or more pips against us, you know, it would have only happened before any kind of peak profit of only would have happened 18 times. However, if we use that 17, then, and so let me break this down for you. So we have 164 trades right here. So 164 trades, and if we had 18, what do we say? 18 losers, then we would have 146 winners, and that would be 89, so almost 90%, right? So if we were at 90%, then the most we could do is going to be a 5-to-1. So let's just say a 4-to-1, right? So that's going to be about 4.25 pips. 4.25 pips. So let's just call it 5 pips. We would have to have 5 pips in profit, okay? Now, if we took our post-trade movement and sorted the same way, then we see that we have, before we get to 5 pips, which is right there, 5.5, because we want to cover spread. So this, the one that says 5, that wouldn't count. That would be a loser, because after that, depends on, you know, where it went after that. But right there, 5 pips. If you hit 5 pips, you're not going to get the trade, right? It's never that we have no spread, right? I mean, maybe for a blip of a second, but we're not going to count on that blip of a second. We're going to just count on the fact that we usually have about 3 to 4 micro pips spread. So 5.5 is actually going to be the first winner if that's how we were looking at it. So we have another 34 here that did not go 5 pips, 5.25 5.4 pips, right? So that's another 34 that we would count in our losing pile, right? Because after 6 candles, it may very well have gone, and you may have to even go back and check, right? And that's why I made these notes, because you can see right here, this one went 0 post-trade movement, and then it went 1.8 pips in profit, right? But then what, right? Because that's not enough. That's not telling us anything, because we need at least 5.4, 5.3 pips, or 17 pips of drawdown, and we don't have either in either of these. But I can see that after this occurred, it went 43.2 pips against. So I know that that's the most peak profit that I got, and after that, it went against. So that's a loser, right? But I had already done that when I collected the information, so I didn't have to go back to that trade to see, okay, did it, after it did this in 6 candles, did it perhaps on the 7th or 8th or whatever candle do something different? And I know that within actually those same 6 candles, that after this occurred, it went 43.2 pips again, so that would have been a loser. But I didn't know that it would have been a loser until after I've analyzed and I'm looking for something specific. In this case, a 5 pip take profit, which would be 5.3, 5.4 pips. So that means that that's a loser, and then the rest of these are checked. If there's a blank space and it didn't hit one of those parameters, like this one went 13.4 and then 3.4, neither of those are either 5.4 or 17. So maybe I have to go back and check that one. Maybe I have to go back and check these to see would they have panned out. Actually, not those. Those are all zeros. But any other ones that didn't go 17 or 5, 5.4. And I don't have a note for, right? But the rest of these I had notes for, so I was good. Okay. And some of them were obviously losers. That's 36.7 and then 4.5. And so that wouldn't have even gotten us close to our take profit. This one, we would have had to go back and check, right? Which is why it's yellow. There were a couple other ones that I turned red. I just didn't turn these yellow. Anyway, so if I did have 5.5 as my take profit, like the starting point, because that's the first one that would have been above 5.3 or 5.4 pips, then all these would then be losers that I may have to double check. But at first glance, they'd be losers. So that's 34 more losers. So if we go back to what we were doing here, then we would add 34 more to that, right? Which would be 44, 50, 52. Or so 44. Wait. Yes, 52. So that would be 52. And then that would bring me down to 68.29. So that's 70 pips, or 70%, but what's the problem? Or 68, so close to 70%. But what's the problem? To get that, we had to use almost a 5-to-1, like a 4, 5, 10, 15. I guess a 5 pip would be like a 3-to-1, 3.2-to-1 or something, right? But it's still, let's just say 3.5-to-1. Even if it was just 3-to-1, that wouldn't work because it's 70%. 70%, 3-to-1 would not work, right? So we have a starting point, but now we need to do better than our first initial, which was a 17 pip stop loss, and then going as far as a 5-to-1 or what have you. So then we look back at the data and say, okay, can we get more than that, right? Can we get maybe a 2-to-1, which would be more like 8.5 pips, right? Now remember, if we add more of these, now some of these are already counted as losers, so that would obviously affect whether it was profitable or count, right? Because all I did was I went like this, and this has 34 of them being losers, but we could very well have already counted some of these as losers, like that one, right? Because they went 17 and some odd, and they didn't go to the drawdown point. So these, I'm double counting if I look at these numbers right here, right? Because I've already counted that as a loser. I've already counted all of these as losers. From here, all of these right here would have been losers that I already counted when I sorted and looked for that 17 mark, right? So that right there, so if we look at that, that would knock off 9 right there. That would knock off 10 and 11, 12. So right there, that would knock off 12, from here. So that would be 40. So 76. So that's a little better, right? 76%. But still, we'd be using too large of a number, because even at 80%, we're okay to use a 3-to-1, but we're more like a 3.2, 3.3 to 1 with just under 80%. So that's not going to work. And it could be a little profitable, but maybe not. So what we established after kind of looking at it that way, what I established was I could get a 12 pip stop loss and a 5 pip take profit and make profit. It's a 72% win rate, right? And right here you can see 118 trades for 5 pips. Each trade is 590, and then 46 trades for 12 pips is 552. 590 minus 552 is 38. That would be 38 net pips. That's not a lot. That would be pretty crummy. So then I said, okay, let's look at it a little further. So I took the times and I broke them down. How many did I get at this time? How many did I get at that time? So on and so forth. Win, lose, total, win, loss, and percentage. So 72, 71, 82%. Then it dropped to 69, 62, then back to 71%. I said, okay, well, what if I just took out these then, the 3 and 4 o'clock? So right here you can see that 12 pip stop loss and a 5 pip take profit, but not trading at 3 and 4 o'clock is more profitable, almost by double. So I'm at 73%, so only 1% more, but I'm actually at a higher net profit. So I take that, right? But then I say, okay, we can do better because we haven't even scratched the surface yet, right? How do buys do versus sells? Well, buys are at 68%. Sells are negative. If I took just the sells, I would have lost money with those parameters, right? 5 and 12. I would have lost money with the sells. Okay? So then I said, okay, well, what if we just took out these times and took out all the sells? Then what would happen, right? So right here we have 12 pip stop loss, 5 pip take profit, buy only. It brings us up to 75%. Okay? Buy only, now we're at 68 net pips, where the best we got right here was 61. There's the 68 right there, right? So it's the same thing that you're seeing up here, right? Broken down by hours. Now, what if we said, okay, we're only going to take buys, and we're only going to go between 3 and 4 o'clock, or not going to take trades between 3 and 4 o'clock, UTC. Then we get to 95. So now we're only taking buys, and we're not trading at 0300 and 0400 UTC, because that's what's most profitable. You're taking less trades, less pips, right? But you're making more money. That's the idea. So again, you don't always feel like you have to be taking trades. You can see this is total 87 trades. 87 trades versus if we looked at all of them and for these hours, it's 164. So half, almost a little over half of what we would have been taking is more profitable. It's at 77%. And then I said, okay, well, let's look at it a little further. So we took this and we said, well, what if we did a 12 pip stop loss and a 4 pip take profit? Okay, so we did a 12 pip stop loss and a 4 pip take profit, which makes it a 3 to 1, where a 5 pip take profit is less than a 3 to 1, right? So it's like a 3.3 to 1 or something. So now we're actually we have more risk, right? Because of our risk to reward. We have a 12 and 4, which is a 3 to 1 versus a 12 and 5. But we find that we actually win them 84% of the time and have a net of 240 pips. Okay? And that's just straight across looking at all of them. We haven't looked at hour by hour. We haven't looked at buy versus sell. We haven't eliminated any low-hanging fruit. All we did was just said, well, let's just play with the parameters a little bit. Then what would we get? And that's how it fell out. Much more. That's 240. Okay, the closest we got here was 95. We more than doubled our profit, our net profit. This is net pips. After wins and losses, that's your net pip, right? So after wins and losses, that's our net pip. And our net pip was 240 versus just 95. and we took all trades, 164 of them. We didn't leave any of them off the table. Okay? And again, we just scratched the surface, right? Because we could still go in here and say, okay, let's look at it hour by hour with those same parameters. How did that fall out? It's likely that these would still be our low-hanging fruit, and it's likely that the sells would still be our low-hanging fruit. So what if we took this scenario and we used these parameters, right? We took out 3 and 4. Well, we would check first. We took out 3 and 4, and we took out the sells. If this jumped us up from 75 to 95, right, what would this do? 240 to what? It could be a lot more profitable, right? And look, this is just that time block. And I haven't even looked at drawdown. I haven't even looked at, okay, do these normally draw down for a certain period of time or for a certain amount of pips or a combination of the two? Well, what if I waited for the drawdown, right? And if I waited for the drawdown, then executed, am I going to have a higher win percentage? Am I going to have more success in the trade? Are certain trades that would have very well been losers, are those going to win? Right? There's a whole bunch of stuff in there that we haven't even touched yet, and already, just at a first glance, we found something that's highly profitable, 84%. 84% with a 3-to-1. So we're not just 80, and that gives you margin of error, right? Because you're going to have about a 2 to 4% margin of error, which means this trade, its win percentage will fluctuate anywhere from 80 to 88%, right? Because it's about a 4% margin of error. So 80 to 88% is what you're looking at. So at a 3-to-1, that is going to be really, really profitable. And you're going to be able to use a really solid risk percentage because it's winning 80+% of the time, which means you have a lower percentage, a probability that you're going to have a lot of back-to-back losers that are greater than 3. You may have 3 back-to-back losers pretty often, and very, very, very seldomly 4 back-to-back losers. And then probably, the exception would be 5 back-to-back losers. You'd probably rarely to never get that, right? So you're planning on 3 to 4 back-to-back losers. So you could use a 3% risk, right? Because 3 back-to-back losers or 4 back-to-back losers at 3%, that's less than 12% loss from wherever you are when you first started that sequence. Right? So you're still under that 15% mark that we want to stay under, and obviously you're not risking more than 5% per trade or concurrent trades. So let's look at, let's analyze this really quickly. Let's look at this, okay? And let's say we're going to use a 12 pip and a 4 pip instead, right? So if we did that, then let's see, okay, so we got post-trade moves, so let's do this real quick. Let's go here. And let's clear that up. No fill. Okay, so everything that is not 4 pips, right, if we did it this way, would be about right there, because that goes to 4.5. So it'd be about right there. So let's go through this, and probably the easiest way to do this is going to be, let's see. Okay, so we know all of these didn't cut it, so make those red. Those are all losers, and those are already marked as 2. And then right here, that would be a winner. Nope, that would not. That would be a loser because it went 36.7 against first. So that would be a loser right here. This one would be a winner right there. This one would be a winner because that went 5. So 0 drawdown at first, 5 pips profit, and then after that went 14.5, but that doesn't matter because we would have gotten our 4 pips first, so that's a winner. And I know all the rest of these are going to be winners because we have 5 5 pips or more. And then this one is, it went 17.1 and then went 6.1, so that's a loser. And then that went 6.3, so that's a winner. 13.6, and our stop loss is 12, and then 6.6, so that's going to stay a loser. Let's go down the list here. That's a loser. Well, actually, check this out. So I made this note. Went 5.7 pips in favor with 0.5 drawdown over 2 minutes. So the first 2 minutes of this trade, we would have taken profit. So the backtest data looks different, right? It went 26.3 pips against and 10.6 in favor after the 6 hour. So look, 3:45 and 15. So that's the whole, that's like 5 hours right there, right? So that's what happened in 5 hours. But the first 5 minutes or first 2 minutes, I would have won that trade because it went 5.7 pips first. So that means that this one, which would be a loser at first glance, is now a winner. And I don't have to go back because I had already made that note. Right here, 19.9, 12.8, so that's going to be a loser. Right here, this is a winner, and let's see, let's check this one here. This one is, that went 12 and 13.5. That's tough, but let's just mark it as a loser, as is. And then if we go here, that's a loser. And here, I went 15 and then 20. I went 14 and then 21. And then I went 14.9 and then 21. So those are losers. Let's do this. Okay. I don't know why that turned red. That's weird. Okay. So here are the twos. So right here, okay. 18.6, and then went 26.5, 13.7, 27.5, 18, and 55. Yep, so those are losers. Good, so those are already marked correctly. Okay. So right here, we've got 121. Where did I miss? I missed something. Because I have 138. Okay, so there must be more in there that I missed. Let's see. So this one right here, for example. Okay, so let's just use, I don't want to take too much time doing that. Let's just go based on what we see here. Okay, so let's say that's not going to work. No, it's just going to take too much time to do that. But anyway, what we would do is we would sort it again. We would break it down based on the new winners and losers, and we would break it down by hours. And then we would look at, okay, where's our, that one at 72%, that's at 71%, that's an 82%. So that's at 69%. That's at 62%. So if we eliminated those 3 and 4, right, what would that look like? Would that make us more or less profitable, or not enough to even worry about, right? And then after doing that, we could look at buy and sell. Okay, did that make us more or less profitable, or not even worth worrying about? Right? And we want to look at our net pips. And then once we've done that, then we can determine, okay, would it be more profitable to, so in this case, not trade at 3 and 4, not trade sells, and with our new parameters, is that going to be more profitable for us? So if you get a good answer right there, great, run with it if you're happy with that. But it is always worth it. It's always noteworthy, worth it to go back and see, can you push the envelope further? You've done all the work, may as well see if you can push the envelope further. So again, we haven't looked at duration, right? Does this duration have any bearing, and I think what we established was like waiting 2 or 3 minutes or something would be more effective, right? So does the duration, because we can see, look, some of these, very few of them in the grand scheme of things, about 23 of them had 0 duration, right? There was no drawdown, it's just 0 duration. And then right here is like 2 minutes, right? And right there, 2 minutes. So if we looked at this right here, and we said, okay, everything actually from here down, that's 141. So there's 164 of these, 141, and then that divided by that times 100. That's about 86% of the time. 86% of the time, we draw down at least 2 minutes, at the very least, right? We could even say 5 minutes and be pretty close to 86, 85%, right? 86%. If we said 5 minutes, because look at that, there's only 2 that are at 2 minutes, right? So if we did this, and we said, okay, well, what about 141 of them, so 139, yeah, 85% of them draw down 5 minutes or more. Okay, so what if we said, okay, we're not going to take the trade, so let's take a loser, and this is what we were trying to do last week, just kind of ran out of time. So let's take a loser, let's go over here to the main, and let's look for a loser. That's definitely a loser. No, that's a loser. Okay. So let's look to see, would it have benefited us if we waited 5 minutes? Sometimes it's not going to, but other times it might. That would have been a loser if you didn't do that. You know, so would it have been a winner if you did do it, if you did wait 5 minutes? So let's look at this. It's 4/14/2016. Let's go to our chart, and let's go to 4/14. And it was at what time? At 1900. Okay. So right there. There's the setup. Everything is present. Now let's wait. This is a 1 minute chart, so let's wait 5 minutes and see if it would have made a difference. 1, 2, 3, 4, 5. We're looking for a sell, right? So now we're here, about 3.4 pips. Right, and we're looking for what, 4 pips? So, yeah, from right there, right, we're looking for 4 pips. We wouldn't have gotten it. We would have gone about 1.6 pips from there to there. So let's see if we would have gotten 4 from here. Yep, 6.3. So would that have been a winner otherwise? Right there, it went 2.1 drawdown. Oh, sorry, no. Nope. Yes. So right there, it only went 2.1, or sorry, not from there. Erase drawing. From right here, it only went 1.6 pips, and then it went against, right? But we waited 5 minutes. 1, 2, 3, 4, 5, right there. And then we entered, and we got our 4 pips. Now, we know that had we not, it would have only gone 2.8, and then went up 12, and that would have been a loser. If we would have entered right there at the end of that candle, we would have only got 2.8 pips. And then it would have gone up 12 pips, and we would have been stopped out. So that trade is marked as a loser on our sheet. But now we know, right, that if we wait 5 minutes, and I'm not saying we know that for sure, I'd want to look at more examples, but now we know that if we wait 5 minutes, then we could potentially make a loser a winner. In this case, it worked at random. Let's check one more, just to see. So let's find one that's obviously a loser. So 12.9, 12.8. So that's a loser right there. That's barely a loser. Went 4.4 pips in favor with 3.1 drawdown in the first 5 minutes. Actually, this is one of the ones I think we changed over. So that one would have won. We can see that, and I don't have to go back and check that because I had made that mark, right? First 5 minutes, it went 4.4. We were only looking for 4 pips. So let's look for a different one. Let's go, let's look for a more recent. So right here, drawdown. Let's find one that's 12, 12.7. So this one's 0, 0. All it did was went against, right? So what if we would have waited 5 minutes, 6, 7 at 18? Because this one could be tough. This one could just not, there's no chance, right? But let's check it. 18, 6, 7. At what time? Oh, I think it is at 18. No, 23. 6, 7 at 23. Right there. Okay. What if we wait 5 minutes? So we're looking for a sell, right? 1, 2, 3, 4, 5. Okay, it only went 5 micro pips at that point, right? And then it went up 7.2. And we're only looking for 4. So right there is where we would enter 5 minutes later at the end of that candle. 1, 2, 3, 4, 5. 3.6. Oh. So that went 3.6, 3.6. Nope. That's up 1.4. So it's not, hasn't killed us yet. We're not out yet. 11.6. Yeah, that probably wouldn't have helped. That went 11.6 already. I don't think it's going to come back. Might. So we're looking at 3 hours now. Actually, I think it does. Look at 11.6. So that would not have stopped. It didn't hit 12. 11.6 is not 12. Yeah, look at that. It would have won. I got close, right? Too close for comfort. But it would have won. Waiting that 5 minutes. That 5 minutes right there, I mean, we barely missed. And depending on when you push the button, you know, maybe it would have stopped you out. But look at, I mean, right there, 3.6 pips, that's pretty close by itself, right? I mean, that is like too close to call, right? But then it ends up coming out and making profit. So waiting that 5 minutes. So you can see that sometimes, and again, that's why I said we hadn't even scratched the surface when we were looking at these parameters and saying, okay, we found something really good, right? Found something really good, but it could be better. Because then you've got all these other trades that could, I mean, right there, that was at least 2 trades that were first losers and now winners. And this is at a 3-to-1, okay? So every loser that you don't have saves you that 3, right? So if you're risking 3% and you convert a loser then to a winner, well, you just kept that 3%. So you made 3%, right? You're not going to see the addition. You're just not going to see the subtraction. So it's like working with negative numbers, right? You're not seeing the addition. You are seeing the addition because you're not taking away from your profit, because you're not seeing the subtraction. So right here, if we look at it just in numbers, right, we took 2 more winners, right? So that's 140. Let's see, which one is... Yeah. So 24. So 85%. And so, I mean, right there, it brought us from 240 net, right? And 84%, just those 2, removing those 2 losers, brought us up to 85% and 30 some odd more pips net. So you can see it works really effectively. It works really when you look at it in those terms, right? Because in one instance you're removing 12, like in 12 pips, you're losing your 3%, and another and you're adding it to your 1% growth, right? So now you have not lost 3%. You've actually made up 4% because you didn't lose 3%, and you made 1%. So now you've basically earned an additional 4%. Right? That's literally you made 4% because you didn't lose 3 and you earned 1. So 3 to 1, any small, minute tweak that you can prove out could be exponential growth. Exponential growth in your 1% extra, right? Could be exponential growth, a fraction of a percent even. It could have really, really exponential impact because, especially with this scenario, we're at a 3 to 1, right? 4 pip stop loss, 12 pip take profit. So that's, and I want to show you guys that because some of you guys, you're tempted to go back and just back test and say, okay, can I get a 5 pip stop loss and a 5 pip take profit? Or what if you said, can I get a 12 pip stop loss and a 5 pip take profit? The answer is yes. You get that answer and you're like, okay, good. I back tested it. I'm good. Great. You've got a profitable trade, right? But look what you're missing out on. That's 38 net pips. 38 net pips versus 272 net pips. You're missing out. So worst case scenario, you back test it and the answer is no, you can't trade it because it's not profitable. So then you got to go back and do it again. And that's usually what happens. Right? That's like 90% of the time what happens. You go back and you test something and it doesn't work out. The win percentage and the risk reward don't make profit. So then you got to go back and do it again and again until you find something that's profitable. And then finally you find something that's profitable and you think, oh great, I did it. Awesome, clack your heels, and then you start trading it. Awesome. But again, that's not, you're missing all of this money. You left all this money on the table. All that money you left on the table because you don't want to do the extra work. So I'm telling you, doing it the golden ratio analysis way, this is the way that we developed, and look at what we're able to extrapolate from this. We can dissect it 5 ways from Sunday because we have all the information we need. Okay, so I wanted to go over that with you guys, just kind of show you guys briefly how we manipulate the data. When I'm done with this data, it's likely that I'll post it. I'll put it in the mastermind so you guys can use it, use this video. You're not going to get an alert for it. Maybe later, maybe at some point later if I can figure out how to do it in Green Chart 2. But you can trade it, right? You can, when you see it, you can trade it based on backtest data, and I'll provide that backtest data when I'm done analyzing it and finding the best, the most optimal parameters for it. And so look forward to that. And with that, guys, we're going to wrap up. I appreciate you guys joining us today. If you guys have any questions, as always, feel free to reach out to us, info@daytradesmart.com. You can go to the website, the Mastermind website, and at the bottom of just about every page, you have that Q&A box where you can submit a question. So definitely bring those. One other thing really quickly. On Thursday, we are having a webinar, Thursday, 6 p.m. Mountain Time. We're having a webinar this is for new prospects, right? This is like our marketing where we bring in lights and then, they upgrade, things like that. But we're going to cover a lot of this stuff, 7-figure day trading, okay? So I want you guys to attend because I want you guys to ask questions, primarily because when I do these webinars, I get soft pitched, right? People don't ask the hard questions. Some of them because they don't know what the hard questions are. Others, if they do ask a hard question, they email it. So they don't ask the question on the session, on the webinar. It's a 2-hour webinar. But my hope is that you guys will attend because I want you guys to throw hard questions, even if you know the answer to them, right? I want you to throw the hard questions because it benefits new people and people that have been in the industry for a long time. When they hear questions that maybe they want to ask and they don't, or they've never even thought to ask because they've been doing day trading all differently and all backwards, right? So if you guys have the opportunity, 6 p.m. Mountain Standard Time, 8 p.m. Eastern on Thursday, in the description of this webinar is a link to register with Webinar Jam for that session. So go in, register. Hope to see you guys there. If you are there, ask the hard questions. Again, even if you know the answer, because I want for people to get this information. I want them to be able to benefit from it. And sometimes if they don't know the right questions to ask, they stay stuck, right? So hopefully you guys will join us for that. Otherwise, we'll see you next week. Have a good one. Happy trading.